Welcome to the jungle. What is the stock market? The stock market might sound like a scary place, but don't worry. It's not as complicated as it seems. It's a place where people come together to buy and sell ownership in companies. Think of it like a giant flea market, but instead of selling old clothes and furniture, companies sell little pieces of themselves, called stocks. These stocks represent a small part of the company. When you buy stock in a company, you're essentially buying a tiny ownership stake in that company. This means you own a small part of that business. And just like any good owner, you get to share in their profits. Or losses. If the company does well, the value of your stock goes up. If it doesn't, the value goes down. Now, this flea market doesn't operate out of someone's garage. It's a highly organized and regulated marketplace. It exists electronically on stock exchanges, with the New York Stock Exchange being one of the most famous. There are also other exchanges like NASDAQ and international ones. You need a broker to make trades for you. They're like your personal shoppers in this market. They help you buy and sell stocks. So whether you're a seasoned investor or just starting, remember this. The stock market is where companies and investors meet to trade ownership of these companies, and it plays a vital role in our global economy. It's a place of opportunity and risk where fortunes can be made or lost. Buying and selling stocks is like trading baseball cards, except these cards can make you real money, or lose it. The stock market is a place where fortunes can be made or lost in the blink of an eye. You buy shares, which are like individual pieces of a company. Each share represents a small ownership stake in that company. Let's say you buy 100 shares of Pizza Palace at $10 per share. This means you believe in the future success of Pizza Palace. You just spent $1,000. This is your initial investment, and now you own a part of Pizza Palace. Now you're hoping the price of those shares goes up. If the company does well, the value of your shares will increase. If Pizza Palace invents a self-baking pizza oven and the stock price jumps to $20, you can sell your shares for $2,000, doubling your money. This is the dream scenario for any investor. But remember, just like pizza toppings, stock prices can go down too. The market is unpredictable and can be influenced by many factors. If Pizza Palace gets sued for using pineapple, your shares could plummet. Bad news can drastically affect stock prices. That's why we diversify, but more on that later. Diversification helps spread risk across different investments, making your portfolio more resilient. Why do people jump into the stock market roller coaster? It's not just about making a quick buck, though that's always nice. Investing in stocks can help you grow your wealth over time, beating inflation and making that money work for you. Think of it like planting a money tree. You put your money in the market, and over time, it can grow into something much larger, thanks to the power of compounding. Of course, there are risks, just like with any investment. The market can be volatile, meaning prices go up and down, but over the long term, the stock market has historically trended upwards, making it a solid option for building wealth. Section 4. Talking the talk: stocks, shares, dividends, and indices. Let's learn some lingo. We already talked about stocks, which represent ownership in a company. Shares are simply the units of ownership you buy and sell. Dividends are like bonuses for owning a company's stock. Some companies share their profits with shareholders by paying out dividends, usually in cash. It's like getting a little thank you for being a loyal investor. Finally, market indices are like report cards for the overall stock market. The S&P 500, for example, tracks the performance of 500 large companies. These indices give you a sense of how the market is doing overall. Section 5. The big picture. The stock market and the economy. The stock market is like a giant mood ring for the economy, reflecting the collective emotions and sentiments of investors. When investors are optimistic, they buy more stocks, driving prices up. This optimism can be fueled by positive economic news, strong corporate earnings, or favorable government policies. This is called a bull market, characterized by rising stock prices and general investor confidence. But when investors are feeling gloomy, they tend to sell, causing prices to drop. This pessimism can be triggered by economic downturns, poor corporate performance, or geopolitical tensions. This is called a bear market, marked by falling stock prices and widespread investor caution. The stock market also plays a crucial role in helping companies raise capital. By going public, companies can access a larger pool of funds. When a company wants to grow, they can issue new shares of stock to the public, raising money to invest in their business. This influx of capital can be used for expansion, research, and development. This helps create jobs, develop new products, and boost the economy. The ripple effect of a thriving company can be felt throughout the community and beyond. So, there you have it. The stock market is a complex but fascinating system that mirrors the health and direction of the economy. The stock market may seem intimidating, but by understanding the basics, you can start your investing journey with confidence. Education and research are key to making informed decisions. Remember to do your research, invest for the long term, and never invest more than you can afford to lose. With patience and diligence, the stock market can be a powerful tool for building wealth.